Hello, everyone. Welcome to Property Zone Live again. Today, we are actually very honored. We have a chance to invite Dr. Alex Chong, all the way from Perth, Western Australia, to join us and share with us his insightful thoughts about the current situation. Are we entering the hyper or high inflation era post-pandemic? Now, just give you a bit of background. Actually, I have never met Dr. Alex. As you know, I'm the old-fashioned guy. So I always like to read the physical newspaper every morning with a cup of coffee. And out of so many columnists, Dr. Alex Chong articles always stand out because you can find the same frequency. And I feel that whatever he share, give us a new perspective of what's going on in the market, in the economy, in the country. Even though physically he's in in Perth, but he shared a lot of things that's related to Malaysian market. So I took a bold move. I actually just PM him through the Facebook Messenger. Luckily, he responded, and he's generous enough and willing to allocate the time and join up with this session. So, without further ado, before I actually move on it, let me just give you a bit of brief introduction about Dr. Alex. All right. So Dr. Alex holds a PhD in computer science. Yes, computer science. But I will go to that later. Okay. From Murdoch University in Western Australia, which is at Perth. And he's currently the software development manager for the Department of Justice in WA. Okay. He's basically a columnist from Sinju Daily, which is the most best-selling newspaper in Malaysia. Basically, he also invited a guest lecturer for Murdoch University and writes for Australian Asia Business Weekly. Okay, he has been interviewed by IFM, Astro Hotspot. He's actually very passionate about investment. Okay, he likes to invest in stock, unit trust, property, and his current investment portfolio spread across different continents, including Australia, USA, of course, the homeland of Malaysia. Now, doctor, so I think the audience will have a lot of questions, computer science, but what got your interest and passion about investment, financial, economics, and all the market things? Can you share with us more about it?
Sure. It probably started, I guess, about 17 years ago
All
when
right.
I started trying to build my own investment portfolio. And economics has been one of those subjects that affects investment a lot, in my view. It's one of those subjects that not only affect investment, but it affects all aspects of our life. So the way I see it is you can see it from multiple perspectives. And I like to look at economics from layman's perspective as opposed to the policy maker's perspective. And yeah, so I write about it. I'm passionate about it, and yeah, some of the readers likes it as well. The fact that we can use simple terms to describe economics and relate it to daily life activities. So yeah, really look forward to this chat. It's my first English interview that I've done, and
First English interview, or how honored we are. So I like the word economics. Sounds like a big word, but economics is not just something the policymakers do, but it's something that affect every individual from different aspect, from all walk of life. I think that is actually a great impact of it. So without further ado, let me just jump into the topic for the session today. So as we discussed, what we are seeing, maybe Malaysia, we don't feel it that much, but if you have actually followed the news around the world, we have seen natural gas goes up by 500% in Europe, right? We have seen UK shortage of petrol because of the shortage of the truck driver. We have seen China is having acute shortage of power supply. So all these things, in a way, has pushed to leads to inflation because of shortage of almost everything. Okay, not just material, but also labor. So, in general terms, what you think are the pushing hands behind um, the reason that is actually leads to high inflation, Doctor?
okay. So I guess if you look at inflation again from a layman's perspective, um, we're talking about price going up. We're talking about things getting more expensive. And that happens when you have too many people chasing too few products. So you can imagine yourself going to, say, a luxury shop, Gucci or Prada, LV. And what you see on the shelf is generally one bag, very luxury bag in there, and then miles away you got another one. You don't have a lot of them. So you produce very little. But there are lots of people wanting to buy those products, and they are willing to pay a high price. So that's how prices go up. So if you talk about the pushing hands here, so, we can rewind back to the beginning of the pandemic. What countries are doing all over the world is that they're trying to save the economy, and they do it by three methods, right? So the central banks lower the interest rate. That's so that the whole goal is to try and maintain a liquidity. So they're trying to make sure that there are plenty of money flowing around. So when the interest rate is down, corporations can borrow, and corporations with already borrowed money do not need to pay too much interest. So they have money at hand and they can save their business. So that's the first thing they've done. But some central banks also go beyond that. So United States and Australia, both countries' central bank actually gone to what we call quantitative easing, which is a way to boost up more money supply in the market. So what they do is, as central banks, they have the ability to create money. So what they've done is they created more money. They use the money to buy government bonds and securities from the secondary market, and that is really equivalent to injecting a lot of money into the capital market. So now you've got money that corporation can borrow. You've got money in the capital market. And then the third thing that's being done by the countries are that the government stepped in, and the government has been doing handout. So they borrow money, they hand out to people. So if you look at the United States, the parliament has actually authorized about $5.9 trillion as a rescue package. If you look at Malaysia, we've done similar things. We have about a USD $100 billion package spread across 7 of them, 7 or 8. And that's a lot of money. So then we hand those out to the people who needed it. So now you also have lots of money handed out to individual, apart from capital market and corporation. So now that is actually pushing up demand. So now demand, or at least we're preventing the demand to collapse. So on the one hand, you've got people buying things now, you've got the demand. The other side of it, which is about the supply, the countries are trying to contain the virus. And what they do is they do lockdown. So in a lockdown situation, business cannot be conducted in a normal way. So producers are not able to produce things in their normal circumstances. And that led to shortage. So we're running out of things. So in Europe, we're running out of energy, like you say. We're talking about tenfold price increases. In the US, we have the same thing, about 25% energy increase, and we're running short of truck drivers, which means even shipping containers, we can't deliver things, and we're running out of containers as well. And even in China, we're running out of coal, and hence some of the factories are forced to slow down their production. So these are all the supply constraints that have been imposed, and that's really an indirect effect of the lockdown. So the virus didn't cause it, but our lockdown did. So on one hand, you have a lot of money, you have some demand, and you don't have enough supply. So those are, to me, is the pushing hands for inflation. Yeah. So if you drill down, you see a lot of individual little things that can explain inflation. But really, overall, if you look at it from a high level perspective, I think these are the two categories of inflation forces.
Okay, thank you for your answer for that. So I'm just gonna keep dwelling a bit further on the money supply. So we are witnessing our money supply most likely measured by M2. I think if you want to know more about definition of M2, people can actually Google a bit, give you a better understanding. But M2 basically is a benchmark. We measure how much money supply is in the market. So if you take a closer look at the money supply, previously there's a highest M2 in the whole world, in US in particular, was right after First World War. right? World War One, because they want to boost the economy, they want to stimulate the economy, liquidity to be pumped into the market. But now, a simple thing called COVID-19 has bring us to a new benchmark, bring us to a new height in terms of the money supply. Okay, but at the moment, US are talking about increasing interest rate. US are talking about the word called tapering. And Doctor, maybe you can share with us more about the definition before going to the impact. So, are we seeing inflation coming down because of what US? Because US is always, whatever US is doing is always has impact to the rest of the world. So, what do you think? If Fed is going to tapering, and maybe ultimately slowly increasing the interest rate, would that bring down the inflation to a certain extent, or there are other things we should watch for? Doctor, over to you.
That's a very, very good question. I mean, we talk about markets, we talk about a lot of money, but how much money is a lot? And that measure M2 is one of the many measures. I guess we have M1, M2, M3, but M2 is really the prominent one watched by the central bank mostly. Now, in order to understand what's going on, we need to talk a little bit about M2 itself. So what's M2? M2 is really measuring the amount of money we have, and we go about doing that by, we look at the banks, we look at what's in the saving account, what's in the check account, we add those money up, etc., etc. We also add in what we call the near money component, so things that are not actual money, but they can be converted to money easily. So that includes things like money market fund, mutual trust. So they all get added up, and you get this supply called M2. Now it's worth pointing out that M2 probably within a year, within the pandemic situation, the M2 supply has actually gone up by about $2 trillion. Now that coincides with the central bank doing quantitative easing and countries doing handouts and interest rate being low. So $2 trillion is a lot. So if you look at year 2000, M2 was only about $4 trillion. So within a year, we've actually upped it by half of what we had back then. And Sean's right. So now we're talking about tapering now. So what is this all about? So the central banks has now injected a lot of money. They look at the market. It's kind of recovering. We have GDP in the US growing now. We're out of recession because of that. And unemployment rate is also coming down. So they're now talking about tapering, which is really the process of tightening the monetary policy. What does that mean? So you can imagine this as a tap, right? If you loosen the tap, money flows out. So if you tighten it, some money goes back up. So the way to do that is that they're thinking about raising interest rate. Now, nobody thinks, I suppose, in terms of the US raising their interest rate. The estimate is that they will probably do it end of next year or the year after. So that's still a while to go. The other thing is they're talking about reducing the quantitative easing process, which we've just explained. So they're going to not buy as much bonds and securities from the market, and they're starting that process next month. And so naturally, people's going to think, okay, now when you do QE, our money supply gone up by $2 trillion. Now, if you're going to do the reverse, what's going to happen to the money supply? Now, it's worth pointing out that over the last 20 years, we've never had M2 coming down. It always just go up. So it start from 4 trillion to before the pandemic, it was about 18 trillion. And now we're about 20 trillion. So it always goes up. So, and during that time, in 2008, we have a financial crisis. And US has done quantitative easing at that time as well. And then they started tapering off in 2013, and I think they completed the process a few years later. So money supply still gone up. It doesn't go down. Now, however, if you talk about inflation though, will this money, the change of the money supply actually impacts inflation? That is a deeper question. So the way I see it is M2 is really the amount of money you have. Now, those money, you can imagine yourself as a corporation. In your corporation, you have a lot of money. So naturally, if you have a lot of business activity, but very few money reserve or cash that you can draw from, naturally that's a concern. So that's why economists sometimes compare M2 with GDP growth, because they want to see that if your business or your GDP, you're producing a lot of goods and services, that's going very hot, but you don't have enough money supply growing at the same rate, then that may be a problem. And that's why a lot of if you read articles, they're not actually concerned about the M2 going down. They're concerned about M2 not growing as fast as it needs to be. So that's the one point. Now, however, if you go back to the example, the daily example of corporation, having a lot of money in the corporation, does that necessarily means price gonna go up? And when the money, if the money liquidity reduce, does the price go down? Now we can sort of infer that by looking at the society as a whole. Now, if you look at the society, we live in a world where there's a fair bit of gap between the rich and the poor. So we're talking about 1% of people holding about 50% of wealth. So a lot of money sits with the top tier. But the real spending power actually comes from the middle class rather than the top tier. So even though we have a lot of money, it may not necessarily translate to a lot of buying power. So that's how I look at this, is that the inflation may not be directly impacted by M2, because it's all about how you use the money or where the money is, who is having those money and what they're doing with the money, rather than having a lot of money in the pool, which is what we have now. So in fact, if you look at the Federal Reserve, they have an FAQ on their website, which I find very interesting. They actually say that they used to look at M2, but now it's no longer the main measure for central banks in terms of guiding their monetary policy. And that's for the reason that I just explained. It's having money doesn't not just translate to having inflation. There needs to be certain driving force behind it. So it's people using the money in a different way. So that would be my view about M2.
Okay. Maybe if I can just summarize and illustrate what your point in the layman term, but stand to be corrected. Just imagine one very rich uncle, but he only drives an old Myvi and go to the coffee shop and eat wonton mee. But all the things that he had done is actually contribute to part of the GDP of the country. But let's say his net worth is 5 million. But due to the money supply increase, his net worth now increased to 10 million, from 5 million to 10 million. But if he actually doing the same thing, still driving the same old Myvi, he still goes to the same coffee shop and eat the same wonton mee. So, in other words, that inflation will not be impacted by the increase of money in his account. Is it what you're applying into corporation and the bigger scale of that?
Very, very good analogy. I'm going to write that down. I'll put it in my next time.
Okay,
Exactly.
so can we move to question number 3, Doctor?
Sure.
Okay, so we are facing a shortage in energy resources, as we say. Labors, you have money, you can't find people. Even you want to pay 50, 80 US dollar to get people to come to interview in Miami McDonald's. The effort is so agony. So computer chips, another shortage. Logistic container that you have mentioned has contributed to the acute shortage of almost all commodities. Do you think this is just going to be a short-term phenomenon? So, Doctor,
That's another very good question there. And I think this is probably a very hot topic being debated everywhere. Now, my view is that, okay, let's start with the economist's view. I think most of the media will have reported the fact that a lot of this will be transitory. So it is a short-term thing. And I tend to agree with them. A lot of the factors that are driving inflation should be temporary. So if I go through the inflation force we talked about in question 1, we have on the demand side, we have monetary policy. So governments handing out money, central banks pushing more money into the market. Now we can see that being normalized at the moment. So New Zealand's just raised interest rates. Australia has interest rate rise plan for similar to the US timetable. Haven't heard anything from Malaysia yet, but we are at record low at the moment. Our OPR still standing at 1.75. But it would be very hard to imagine if the government hands out much more money, because our debt to GDP ratio, we've borrowed to the max. So we have our so-called self-imposed ceiling at 60% of the GDP, and we pretty much going there now. And now they're saying, oh, maybe we need another 5% more. But we've increased from 55% to 60, and now we're increasing from 60 to 65 if they made it. But I doubt it'll go on forever. So these things, these inflationary force, will probably be going to slow down and start reversing when the central bank starts to decrease the interest rate and taper off. So I think those are transitory, and they are also within the controls of the authority. So they will be watching central bank's mandate. There are two main mandates for the US central bank. One is inflation, the other one is unemployment. So they will be watching inflation, and they will be tuning the policy based on that. So generally, this shouldn't be contributing to inflation going up forever. Now, if you look at the supply driving force, which is the lockdown, if I understand it correctly, you guys are now, you can cross state. So Malaysia is easing the restriction, and Australia is doing the same thing, and US has already really opened up their economy despite the number of cases that they have. There is no sign of a reversal or anything. UK is also open up, Europe as well. So we're going down, we're going back to less or little restriction. So the supply should then come up again. Now, the other thing to look at also is supply and demand. They normally they have the ability to normalize. So the other thing I haven't mentioned when I answered the first question was that part of the inflation forces could also be due to demand change, because we used to go to shops to buy things, but now we're buying online. So that's why a lot of corporations suffered. But if you look at places like Amazon and online retailers, they were crazily running out of staff because they have a lot of increase in their sales. So those demand shift is also causing inflation in certain area, and that should normalize as well, because if there's demand, there should be supply. People's gonna work around it to try and make money. So all these forces should subside once we get out of the pandemic. So I agree with that part of it. But those are probably not, in my view, they're not the only forces for inflation. There are also some inflationary forces that will persist. Now, in order to understand these ones, we have to go back in time. So if you look at 1970s, before the 70s, we live in a high inflation area. So our inflation rate worldwide is quite high, and in the US it's double digit. And back then we have a lot of welfare as well. So US and UK, they're kind of welfare country. People get looked after, but we have slow growth, and our inflation is very high. So during the 80s, when the policymakers made the change. Now there are a range of policy changes in there, but I'll summarize it based on the mindset. So I think it's a paradigm shift in the mindset. So the mindset goes, we want to open up the economy. We want free market, and we want free competition, so that countries sort of lower their tariffs. We can do more business among one another, and we want free market and free competition. Now that drove down the prices, and the reason is very simple. So if you've got countries, some countries are very good at designing. Say the US, they're very creative, innovative. You get them to do the design. And then China has a lot of cheap labor, so you get them to do the production. And hence, you're really getting products done in the most efficient way, and the price goes down because of that. So that's the good thing about a free market. Now, when you talk about free competition, you're trying to have the best fit to survive. So a company that's efficient will be rewarded, they will make money, they will survive. Companies who are not as efficient will probably be left behind. And then you're left with really strong corporation making products very quickly and very cheap. So inflation's gone from 2 digits to about single digit. And really for the last 10 years, we've been battling with deflation. So we are at the age of zero inflation. And even in Malaysia, there are a couple of quarters, if you look, that are actually below zero. So we tame inflation using that mindset. Now, but there's always a price to pay. The price to pay is that when you do a lot of competition, what tends to happen is that the gap between the rich and the poor can widen, and that creates some social unrest. So if you look at 2008, after the financial crisis, people are quite angry in America. You can see protests all over the country, even Wall Street. There are a lot of people protesting in Wall Street. And what they're saying is that this globalization, this free market thing is not a good deal. We're not getting it. And they're blaming, obviously, the system's not also being regulated well, which causes the disaster, and lots of people lose their homes. So that's social unrest starting to manufacture. And that causes the mindset to shift. So the policymakers have to move away from competition, move away from this free market concept. And many terms describing this, some call it capitalism, some call it laissez-faire, but it's really, to me, the simple layman terms would be competition and free market. So when we move away from it, naturally, prices are going to start to go up. And we can see that in the last few years. So, for example, UK doesn't want free market with the European Union anymore, so they left the bloc. And then US doesn't want free market in terms of, particularly with China. So they have a America first concept. What they're saying is that, look, I'm going to look after myself first, free market second, the benefit of the people first. There's nothing wrong doing that. But as a result, we have trade wars, we have tariffs being increased, and we have technology war. So that led to, like you say, computer shortage is one. The US stopped supplying some of the critical components to Huawei. So China's going to buy it from somewhere else. And the raw material for computing has been increased because of that. Tariffs all over the shops being imposed, with creating more price upward pressure for import and export. So it was originally between the US and China, but it's now also China with Australia, Europe, everywhere. It's pretty much everywhere. And these inflationary forces, at this point in time, there is nothing reversing them. And in fact, if anything, some of the political tension might also contribute to it. So, for example, we have this new concept of Australia, UK, US joining forces, called this AUKUS. These are just political tension that doesn't help with trade. So free trade is now, I suppose, being suppressed to some extent. Not going away, but they are being suppressed. So if you look at this kind of mindset shift, we are really moving back towards the 70s, where our concern is no longer just profits or price, cheap products or good quality products. We're moving towards, we need to normalize this, we need to redistribute wealth. So if you look at China, their new term is called common prosperity. They're not talking about we want more money. We have enough money. We want to distribute it evenly. And one interesting thing about that is, if you think about Malaysia, when our previous government talked about kemakmuran bersama, which translate to similar terms to this common prosperity. So you can see that mindset shift straight away. So in my view, this mindset is going to cause, obviously, things to be more expensive. They're trying to redistribute wealth, and inflationary forces will come from that. And if you look at the figures as well, so from the 70s, we have 2-digit, we've gone all the way down to zero, and economics goes in cycle. So if you believe in the cyclical theory, then it's not hard to imagine that inflation should go up from here. Yeah.
All right. Thank you very much for this insightful sharing about the point. Okay, whether it's temporary or what are the things, not looking at bigger terms, not just the material, not just the supply of the money, but also the bigger part of it. Using the example they've shared since 70 until now. So you know what, the fourth questions, I'm just gonna put away that we discussed, but whatever I have shared has actually created. So I'm gonna ask an impromptu questions. But the impromptu questions, I think, is very related to you. I think there's also what the audience want to know more about it. All right. So, Dr. Alex, you actually invest in property and you're located in Australia, Western Australia, Perth specifically. So, from what we read, there's a booming time in housing market in Australia, although the magnitude of it is various among different cities. All right. And in fact, Adelaide and then Perth has registered the higher growth compared to the traditional Sydney and Melbourne. So can you explain this general phenomenon? Is it a post-COVID, post-pandemic kind of things due to money supply or due to other factors, or is it because people are holding more positive view in the future? Therefore, they know what they are coming in. What's your view on that, Dr. Alex?
Yeah, another very good question there. Yes, so the Australia market, particularly in the property market, if you look at figures from the past 30, 40 years, our house price obviously jumped up about 10% every year on average. And that again coincided with how we talked about the high inflation area. It's coming down, and that also led to our interest rate going down from double digit all the way to today's zero or close to zero interest rate. So as the interest rate go down, the affordability of the property goes up in terms of for people who wants to borrow money. So that's really one very clear and distinguished driving forces for property prices. So within the pandemic, we've reduced the interest rate to record low, and we also do quantitative easing. So there's money supply going up. So if you look at the overall Australian market or property market, it went up by about 20% within a year of time, and Perth registers a double-digit growth as well. So certainly it has to do with interest rate. However, if you look at the past 4 years, what has happened in Australia is that the market housing was cooled down by certain measures. So we have an authority called the APRA, it's called the Prudential Authority, and they recommend policies based on the heat of the market. And what they've done previously is they introduced higher interest rate for investor to try and suppress the investment demand for properties. So as a result, most capital cities registered either stagnant or prices going down, particularly in Sydney and Melbourne. And Perth, for example, it's probably even longer. The downturn was longer. So ever since the mining boom subsided in 2013, our growth slowed down and actually stagnated. So yes, we have about 20% growth this year, but if you average it out in terms of 4 or 5 years, you're really looking at about 4% a year on average. This is still below the long-term average.
More like a catch-up game.
Catch up, exactly. So that's also part of the catch up. And the pandemic helped in the sense that, for example, the Western Australia government, they gave up grants as well. So first home buyer get additional payment subsidy. On top of that, the federal government also has subsidies. So one of my colleagues actually bought a house and he got like tens of thousands of free money for that whole purchase. And you need very little to just be able to borrow money when you have subsidy like that. So that's another factor of the house price going up. But overall, I still maintain the view that so this boom is led by home buyers, which is good for the country because we do want people to be able to own homes. The other point is that it is really just going back to reversion to mean, is what we call. So you're going back to the average rising speed of the normal house price. So I think that's what's happening in Australia.
Okay. Thank you so much. Oh, we have actually come to 35 minutes to the sessions. Okay. I don't want to take any more of your precious time. I think whatever you shared with us today on the topic of inflation, central bank policy, housing market, especially from Australian perspective, it actually just give us some insight and I think a lot of case study we can actually work on that. So with this, I think we're just gonna conclude the sessions for today because we don't want to overload the audience with too much technical information, market updates with that. They will have lose some sleep tonight. So, but again, I really appreciate for coming in today. Among your busy schedule. So with this, everybody, please take care. Bye bye. Thank you, doctor.
Well, thanks for having me.